Well, at that time, they have to pay, just like they do every November, 6 months worth of interest. They're going to have to pay $300 in cash. But not all of that $300 is interest expense. Remember what they just did here at the end of December. They recorded December's interest expense. So when May 31st rolls around next year, what extra interest expense do they have? They've got interest expense for January, February, March, April, and May. They've got 5 more months of interest expense to record. And 5 more months would be an additional $250. They're paying out 6 months worth of interest, just like they do every May 31st, November 30th. But they've only got another 5 months worth of interest expense to record. They already recorded December's interest expense last year. So if you've got $300 that you're paying out, and you've only got $250 in additional interest expense, what's the other $50? It's paying off the interest payable that you recorded last December. Any questions at all about what you see up here? I'll leave that up there as a guide for you all to do one. May 1st, 2009, Thorpe Company issued $100,000 face value, 10-year, 8% bonds, paying interest semi-annually on April 30 and October 30. The market rate at the date was also 8%. The company's year ends December 31st. Basically, it's the same problem you have up here. The only difference is when the payment dates are. Instead of May 31st and November 30, it's April 30 and October 30. If you have any questions, let us know. Let us know if you get stuck. Okay, tell me what's going on here. First of all, when they issue the bonds, somebody raise your hand and tell me what are the two accounts affected and how. Yeah. Increased cash and increased bonds payable. Remember, this is always going to be the case when the market rate and the contract rate are the same. The bond will sell for its face value. This is how much money people are paying for the bonds. Second, what are they going to do on October 30th? Somebody tell me what are the two accounts affected and how. Yeah. He said cash goes down and interest expense goes up by $4,000. That's half of a year's interest. 100,000 times 8% divided by 2. You're making payments twice a year. And then finally, on December 31st, who can tell me what two accounts are affected and how? The company wants to close their books. What do they need to do? Yes, sir.
Interest payable is increased by $1,333.
Very good, because you're talking about from the last time interest was paid on October 30 until now, 2 months have gone by. So they're going to record 2 months worth of interest expense, and since they don't pay any interest until the following April, it's going to be interest payable at this point. So once again, that would be 2 months worth of interest that they have to record. Any question at all about this problem? How many people got it all right? Raise your hand. Got to have maybe about 2/3 of the class at 11 or 12:30 that did. So not as many in this class. Any questions about what you see? This is the easiest of the 3 different kind of bond problems that you'll find. So any questions at this point? Okay, the second kind of bond problem we want to talk about is known as a zero coupon bond. Zero coupon. Coupon rates, remember, are the same thing as contract rates. And the reason why we've got that term coupon rate is that back in the old days, when people bought bonds, everybody would have physical possession of their bond. And those bonds would have coupons on the outside of the bond. And people would clip off the coupon, send it to the company in order to get the cash interest payment. That's why it's called a coupon rate. So a bond that has a zero coupon means it has a zero contract rate. It pays no interest along the way. The company borrows some money today, time passes, and they pay back some money later on. You think about the time value of money. If you were to buy a company's $1,000 bond, that means they're going to pay you back $1,000 sometime in the future. Would you give them $1,000 today? No. You would give them something less than $1,000 because of the time value of money. So what we're going to see on this particular page in your packet is, one, that zero coupon bonds will always be discounted bonds. They'll sell for less than face value. And two, you're going to have a better understanding that bond prices are basically the present value of the future cash flows. What I'd like you to do is notice that this bond that we're talking about has a $1,000 face value. This is the market interest rate of 6%. The bonds are issued at the beginning of 2009. They come due 2 years later at the end of 2010. I want you to look at the bond information down here. Let's say that this was a normal bond that pays a 6% contract rate. If it paid a 6% contract rate, that means that every year you would get 6% of 1,000 for $60. And then you'd get the face value back. So what would you be willing to pay for those cash flows if the market interest rates are 6%? In other words, if you were going to discount these cash flows back at a 6% rate. Well, that's what we do down here. $60 each year for 2 years. This is the present value of an annuity. 2 years, 6%. So the present value of $60 each year for 2 years is $110. Then you also have this $1,000 lump sum. Bring that back to present value using present value of $1. 2 years, 6%. And that's worth $890. So the present value of this bond is equal to its face value. Remember I told you that earlier. When the contract rate and the market rate are the same, the bond will sell at its face value. That's because the present value of the bond's cash flows is equal to the face value. But what if instead we're looking at a zero coupon bond? A bond that pays no interest along the way. All it pays you is the face value at the end of the maturity date. This bond will pay $1,000 2 years from now. Nothing until then. So how much would you be willing to pay for that bond if market interest rates are 6%? Find the present value. $1,000 times the present value of $1, 2 years, 6%, is $890. Meaning that you would be willing to pay $890 now in order to get $1,000 back in 2 years. And if you did that, you would be earning a 6% rate of return each year. From the company's perspective, they're borrowing $890 from you, and they're going to pay you back $1,000 in 2 years. Any question about that? Zero coupon bonds were first issued in any great magnitude by J.C. Penney about 30 years ago. Their thinking at the time was they would borrow money, issuing these bonds, and by paying no interest along the way, whoever loaned the money to the company, whoever bought the bonds, would not have to pay any taxes until J.C. Penney paid off this face value down the road. And then, when they paid off that face value, the bondholder could pay what were called capital gains tax rates, which at the time were lower than the tax rates on normal ordinary income. So it was a great tax dodge for the lenders. Well, after a year or two, the IRS got an idea that whoever bought these bonds weren't earning interest along the way. Even though they're not going to get paid until, say, 20 years later, from the time they loaned the money until they got the money back, they were actually earning interest, even though they weren't getting paid. And so the IRS, with the approval of Congress and the President, decided that they were going to start charging taxes on the interest earned, even though the bondholder was not getting paid interest. So that tax advantage kind of went away pretty quick. There are still some good reasons why investors might want zero coupon bonds, and they still exist today for those reasons. But I want you to be able to take a look at the bond problem on the next page, and we'll go through the things that we want you all to know about zero coupon bonds. This says on January 1st, 2009, Khufu Company issues 2 year zero coupon bonds with a face value of $20,000. The bonds are sold to yield 8%. Remember what that means. At the time these bonds are issued, all the other companies in the world are paying about 8% interest on their bonds. So one of the things we're going to ask you to do is to compute the selling price. How much are these bonds going to sell for? Remember, what you do is find the present value of the bond's future cash flows. This bond will pay 2 years from now $20,000. That's it. There is no interest that it's paying along the way. Remember, this is a zero coupon. No interest is being paid. They are going to pay $20,000 in 2 years. So here's my timeline. 2 years from now, the bondholders will get $20,000. What are they willing to pay right now to get $20,000 in 2 years? This is the discount rate you're going to use to find present value. So we want the present value